Hello and welcome to this special Mutual Fund Corner YouTube edition. Today we are joined by our guest Prabin Agarwal, who's the founder and CEO of Prabin Agarwal Financial Investment Services. Prabin, thank you so much for joining us on CNBC TV 18. And you know, today is going to be a very interesting topic. We keep talking about what to invest in, but we also need to understand what are the mistakes one should avoid while investing for long haul, and what are some of the things that should be kept in mind as well. So thank you for joining us today with your take. And that's exactly the first question. What are the top mistakes one should avoid while investing in mutual funds? You list them and then we'll discuss them in greater detail.
First of all, thank you for having me here. And about the common mistakes, there are a few common mistakes which we usually come across are not having a well-defined financial goal. That makes the investment journey a journey without a proper destination. Chasing past performance, in expectation that the future returns will be in accordance with the past returns. Lack of budgeting, which results in overspending. Absence of risk profiling, which leads to inappropriate asset allocation. Over diversification, causing dilution of returns, or under diversification, causing concentration risk. Market timing, an elusive dream of buying low and selling high. And lack of patience to hold the investment for a prolonged period of time. These are the few mistakes I wanted to discuss today.
Of course, and that is important because patience is required while you're holding on to any investment for a longer term period as well, right? The first thing that you mentioned was lack of goals that one has while investing into equity markets. How important is it to have a goal to invest in mutual funds? Can you just start investing and decide then after that how long you'll be investing it for and for what purpose?
So it is of utmost importance to have a well-defined financial goal. The following questions must be answered before starting the investment journey. What is the absolute amount I will require to fulfill my financial goals? How much time do I have to achieve the goal? How much money I can invest periodically depending upon my current cash flows? And how much accumulated asset I have to allocate towards a particular goal? And above all, what is my risk appetite? This will provide a clear roadmap towards the financial goal. Having a well-documented financial goal will help to review the progress periodically and take necessary corrective measures in between. It also helps in avoiding impulsive emotional decisions during extreme market volatility. See, if we don't have a roadmap ahead of us, the market volatility will bother us more. Even if we have a roadmap, it will bother us. But then we know that where we are going and how long we have to travel. And sometimes we might have a broader objective, such as wealth creation, which rather than having specific goals like children's education, dream vacation, retirement, etc., that's absolutely fine. Even if you are not sure about your goal, start investing. You can align your investments later towards the goal. While speaking about the goals, starting early is also a key differentiator. The sooner you start, you will be able to create a meaningful corpus in the long run. As we all know, the power of compounding works best in the long run and helps create a meaningful corpus.
Okay,
starting early is the key.
Yes, of course, that is very...
And a smart move. The sooner, the better.
Yes, I do get your point there, Prabin. You know, the usual understanding for mutual funds is tracking returns of an underlying, be it the debt side, be it the equity side, be it gold, and be it the other asset classes if it's a multi-cap fund. Is that much understanding enough that, okay, equity is doing a certain way, debt is doing a certain way, just mapping returns, is it enough while you're investing in mutual funds?
Nowadays, investors have easy access to information due to the digital era. Tracking the past performance is very simple. Through any digital platform, you can track the performance of a fund, say for 6 months or a particular category, be it equity or be it debt, say for last 3 months, 6 months, 1 year, and invest according to the recent outperforming funds. We call it recency bias, where investors give more weight or importance to the recent events or performance while making decisions, often neglecting the long-term trends or historical data. It's important to recognize that relying solely on the past performance is insufficient. For instance, in 2021, during the technology bull run, just 2 years ago, during the technology bull run, technology funds were giving a phenomenal return. But now, since then, last 2 years, they are underperforming. Large cap, mid cap funds signed at certain times, but now we see huge inflows and phenomenal return in the small cap funds. Higher interest rate and higher inflation scenario, growth funds tend to do better. The value funds tend to do better. But again, when the interest rates are low, growth funds do better. So essentially the market is cyclical. At times we will see underperformance, and at times we will see outperformance in particular category, particular asset class. So tracking the past returns will not help much. The pattern repeats frequently. The investors tend to chase after recent high-performing funds without fully considering the cyclical nature of the market. This becomes a major problem. Because of that, they buy funds that have recently done well and sell funds that have recently done poorly. In other words, they buy low, buy high and sell low. This compromises the overall performance of the portfolio.
Okay, get your point. But what about the right amount, Prabin? Because you spoke about diversification as well. If one is very confident of a certain asset class, do you think all their money should go in that basket itself?
Again, it's a myth. To derive at the right investment amount, we should first set an investment goal. You are talking about diversification?
Yes, I'm talking about diversification. If one is confident about investing in a particular product, do you think all the amount should go in that particular product itself, or diversification is important, the right amount is important?
Understanding the diversification is a must. We cannot put all the eggs in a single basket. And nowadays, we see asset allocation funds as a category. We have a built-in diversification in different asset classes, say equity, debt, and gold. Diversification works at its best when there is a negative correlation between two asset classes. Say when gold is rising, if equity also tend to rise, then there is not a negative correlation, and you will not diversify the entire portfolio. But we understand that equity and debt are negative correlation. In 2008, during the subprime crisis, we saw the negative correlation. Equities were not doing good, and gold was outperforming. Similarly, again in 2020, during the COVID period, we see a deep crisis in equity markets, but gold again was giving a good return. So there is a negative correlation, and diversification is a must when investing in making a portfolio.
Okay, all right, Prabin, it was a pleasure speaking with you. Thank you so much for joining us. So that's all about the mistakes that should be avoided while investing for a long haul, and what diversification could do if that is something that is taken care of at the right time as well. With that, we'll take your leave on this edition of YouTube Mutual Fund Corner. Stay tuned to CNBC TV 18 for more news and updates.